Hello, and welcome to our Financing Racial Equity webinar series, which started during the pandemic to discuss how we can use capital responsibly to expand economic opportunity for people in communities of color. I'm Buzz Roberts. I'm president and CEO of NAHL, the National Association of Affordable Housing Lenders. NAHL is the nation's alliance of major banks, community development financial institutions, and others committed to affordable housing finance and inclusive neighborhood revitalization. I want to thank our Racial Equity Committee, led by our chair, Lloyd Brown of Citi, for pursuing this webinar series and our other racial equity activities. Today's webinar is titled From AI Bias to AI Balance, Harnessing Fairness Technologies in the Mortgage Market. Today, we will discuss how artificial intelligence can either reinforce or combat racial bias in mortgage lending. AI is emerging as an important technology that will affect us all in many ways. But what does it mean for our work in affordable housing and neighborhoods? Is AI already affecting mortgage underwriting? And how can we use it to advance both racial equity and prudent lending practice? To answer these questions, I'd like to introduce today's speaker, Kareem Saleh, founder and CEO of Fairplay AI. Take it away, Kareem.
Thanks, Buzz, and thanks to Nal for having me. I'm Kareem Saleh, founder and CEO of Fairplay. We cheekily refer to ourselves as the world's first fairness as a service company. And I'm delighted to be here today to share a little bit with you about our work applying advanced algorithmic fairness techniques to consumer loan underwriting in the mortgage market. Let's begin. So I'm going to be discussing some data today from the Home Mortgage Disclosure Act database. That's a database with which some of you may be familiar. The Home Mortgage Disclosure Act requires mortgage originators to submit certain loan level data to the government every year, which in theory allows the public to construct a picture of whether or not mortgage originators are redlining in certain communities, and really to paint a picture of kind of what the state of fairness is in the American mortgage market. That word fairness I'm going to use a lot today, and there are many different definitions of fairness that one could reasonably use. Some of those definitions conflict with each other. When I use the word fairness today, I'm going to be referring to the adverse impact ratio, which is the first definition of fairness that courts and regulators commonly apply to understand if one group experiences a positive outcome, like approval for a mortgage, at a higher or lower rate than another group. So just to recap, the data today is all publicly available data from the Home Mortgage Disclosure Act database. And when I refer to fairness, the question I'm asking is one group experiencing a positive outcome, like approval for a mortgage, at a materially different rate than a control group? Let's dig in. So let's think back to 2021. 2021, of course, was the height of the COVID-19 pandemic, and it was a year that saw massive government intervention into the economy. And so when we looked at the state of mortgage fairness in 2021, the results were arguably quite heartening, because you can see each of these lines on this slide represents the state of mortgage fairness for protected groups in America going back to the 2008 financial crisis. And almost all of these lines kind of start in the bottom left and end up in the top right. So 2021 was the fairest year in the American mortgage market since the housing crisis. And we initially sort of regarded that as a positive finding. Except when we ran the analysis back to 1990, what we saw was over a 30-plus year window, none of these lines had actually moved very much, which is to say, for most groups, mortgage fairness remains stuck at 1990s levels. No net increase in mortgage fairness for most protected groups in America for the last 30-plus years. And then, of course, 2022 happened. And what happened in 2022? Well, interest rates on 30-year fixed mortgages nearly tripled over the course of about 8 months. So from, in some cases, sub 3% to north of 8%. I was just checking this morning for people of moderate credit and conforming loans. Mortgage rates today are somewhere between 8 and 8.3%. And not only did mortgage rates triple, but lenders started tightening credit rather sharply in early 2022. This data comes from the Federal Reserve, from Fred, and what you can see is kind of by the end of Q1 of 2023, lenders, 40% of American lenders had kind of tightened mortgage credit. And so it's no surprise that against that backdrop of higher interest rates and tightening mortgage credit, that mortgage loan volumes fell sharply in 2022. And not only did mortgage loan volumes fall sharply, but they fell disproportionately more for Black and Hispanic homebuyers. So approval rates for almost every group in the mortgage market fell in 2022, but they fell at higher rates for Black and Hispanic home buyers. And it's not just the approval rates where disparities worsened, it's also in loan costs. So there has historically been a disparity in the loan costs paid by protected groups. And for Hispanic home buyers, that disparity was about $750 in 2020. In 2021, that disparity was about $750. In 2022, that disparity, that delta in that disparity widened to about $1,500. So if you're a Hispanic home buyer in 2022, you're paying about $7,500 to close your loan, whereas white home buyers were paying about $6,000 to close their loans. If you want to see what this kind of looks like at a very granular level, like all the way down to individual census tracts, we can build maps. And so what you're looking at here is the state of mortgage fairness in 2022 for female home buyers. In 2022, female home buyers were approved for mortgages at about 99.2%, the rate of male home buyers. That's down from about 99.8% in 2021. And you can see, even though women are almost approved at parity in much of the mortgage market, there are still concentrations of unfairness in the South and the Great Plains. And it turns out that these red and yellow counties all have one feature in common for the most part, and that is that they are rural. And so when we look at the urban-rural divide in the mortgage market, we actually see over the course of 90 years that urban areas are consistently fairer to female home buyers than suburban than rural areas. There's about a 2-point delta in fairness, actually 2.5% delta in mortgage fairness for women as between urban and rural areas. And that delta appears to persist for as far back as we have data, which is going back to 1990. Now let me show you the state of mortgage fairness for Black home buyers in America in 2022. As you can see, Black home buyers were approved for mortgages at 76.4%, the rate of white home buyers in 2022. There are strong concentrations of unfairness in the South and the Northeast. And this number, by the way, is down about 10% from 2021. So in 2021, Black home buyers were approved at about 84%, the rate of white home buyers. In 2022, it was 76.4%, the rate of white home buyers.
Kareem, why do we think that number dropped? Is it just the tightening of the credit boxes in 2020?
I think it's a combination both of tightening credit boxes. We know that mortgage underwriting is heavily driven by credit scores, and the distribution of credit scores is lower for Black home buyers. But yeah, I presume it's also driven by affordability issues, Buzz, because when interest rates triple like that, you can buy a lot less home, or the cost of servicing a loan on a house that you intended to buy is much, much higher. So I think it's probably a combination both of tightening credit and also of worsening affordability.
I saw CFPB just came out with a HMDA report today, and they cited income as an increasing factor in mortgage denial. So that would be consistent with what you're saying.
Yeah. It turns out that if you're a Black home buyer, that states cluster into kind of one of three groups. You have states that are approaching fair, so where Black applicants, Black home buyers are approved at 89% the rate of white home buyers. Then you have a set of states that are kind of, we would call sort of solidly unfair, where Black applicants are being approved at call it 80% the rate of white home buyers. And then you have a set of states which are kind of really unfair to Black home buyers. They're approving Black home buyers at between 68 to 69% the rate of white home buyers. Those are basically the financial crisis era levels. And one of the things that we observe as between the states that are approaching fair and the states that are really unfair, if you look at this column on the right, is you see that basically as as states get blacker, and Buzz, as average median incomes in those states gets lower, the fairness of the mortgage market deteriorates considerably. In fact, there are 5 states, Louisiana, Mississippi, South Carolina, Arkansas, Alabama, where no matter how good the macro environment, no matter how low unemployment, those 5 states all approve Black homebuyers at somewhere between 50 to 70% the rate of white homebuyers. This is the state of mortgage fairness in 2022 for Native American homebuyers. You can see Native Americans are approved at about 75% the rate of white homebuyers. That, as I'll show you in a minute, is way down from 1990 levels. In fact, it's down about 20 percentage points from 1990 levels. So in 1990, Native Americans were approved for mortgages at 95% the rate of white homebuyers. In 2022, that number was 75% the rate of white homebuyers. And we sort of observe a similar pattern with respect to the unfairness for Native Americans that we observed for Black applicants, which is to say, the more Native American your community, the less fair the mortgage market is to you. So when we build the map and we filtered out all of the census tracts from which there were fewer than 30 applications from Native American homebuyers, you get these census tracts that are kind of lit up here on the map, and you can see for the most part they are red and yellow, which is to say where you have concentrations of Native Americans, the mortgage market on balance seems to be less fair to them. And again, we observe a kind of similar feature for Native Americans that we observe for Black homebuyers, which is that states that have large populations of Native American homebuyers, like New Mexico and Arizona, exhibit very, very low mortgage fairness rates for Native Americans.
And that could be connected to perhaps tribal restrictions on liens.
That's right. So one of the reasons we theorize that this may be the case is that it's hard for mortgage originators to perfect title in on Native American lands where there are a complicated set of sovereign immunity issues. Here's the state of mortgage fairness for Hispanic homebuyers. You can see Hispanic homebuyers are approved for mortgages at around 85.2% the rate of white homebuyers. That's down from about 88.8 or 88.9% in 2021. And one of the things that I think is sort of cool about, or heartening about, the Hispanic map, maybe in contrast to the Black and Native American maps, is that if you look at the areas that are known to be heavily Hispanic, so like Southern Florida or the border area in Texas around San Antonio or Southern California, those areas tend to be much fairer to Hispanic homebuyers, right? So the more Hispanic your community, the fairer the mortgage market is to you, but the more Black and Native American your community, the worse mortgage outcomes you experience. This is the map for Asian Pacific Islanders. Asian Pacific Islanders are approved, or in 2022 were approved at 94.7% the rate of white homebuyers. That's down from about 98% in 2021. So approaching parity, but still down about 5% year on year for Asian Pacific Islanders.
So it's interesting looking at all these maps that California seems to have pretty good mortgage fairness. And we know that in many parts of California, home prices are very high. So that I'm wondering if most of the applicants in California have to have relatively high incomes in order to afford those high home prices. And that may be a distinguishing characteristic for applicants of all races in California.
I'm sure that's a relevant factor. Yes, average median incomes in California are higher than the national average. Of course, you have to weigh that against the higher property costs too. So it's sort of difficult to know how that nets out.
But if I'm a moderate income aspiring home buyer of any race in California, there may not be very much stock for me to buy, and so I'm just not going to be an applicant for mortgages.
That's
Right.
true too. That's true too. There may be a kind of censoring effect in the data. That's right. Yeah. So to just kind of like recap the state of mortgage fairness in 2023, for most groups, mortgage fairness is no higher today than it was in 1990. For Black home buyers, mortgage fairness appears to be stuck in neutral. There's been an alarming drop in mortgage fairness for Native Americans going back to 1990. And if there's a silver lining, it's that mortgage fairness for women has improved somewhat in the last 30 years. Now, when I present these findings, I will sometimes say that these are the outcomes of credit decisions that were made through our effort to achieve fairness through blindness. And let me explain what I mean by that. So, we passed the Equal Credit Opportunity Act and the Fair Housing Act 40 plus years ago. And those pieces of legislation prohibited the consideration of race, gender, age, other protected status in making underwriting decisions. And I think that that has led some people to believe that, like, as unfortunate as some of these outcomes might be, they are the result of credit factors or credit variables which are neutral and objective assessors of risk. Right. So they say, yes, Kareem, it's unfortunate that we have such high disparities in the mortgage market, but these are all individuals who must be rightly denied because we are using neutral and objective credit factors to underwrite them. And there's just one problem with that, which is variables that appear objective often aren't. So we were recently doing an engagement with a lender, and we plotted basically the variables they were using on a 2x2 axis, as you can see here, where the x-axis was how predictive is this variable of protected status? So how predictive is this variable of being Black in this instance? And the y-axis was how predictive is this variable of default or risk? And what you can see here is that things like the origination amount on your loan, the number of months since your oldest trade line was opened, the number of times you've been delinquent in the last 12 months are all highly predictive of race. So these variables that we're using that we tell ourselves are kind of neutral and objective predictors of credit risk are actually encoding other information about race as well. And the practice in the industry has been, okay, well, let's just make a list of all the variables and plot them by how biased they are, and then drop or substitute variables for the ones that are kind of most correlated with race. So you can see this is the 24 variables that this lender was using, 1 through 24 listed at the bottom. The y-axis is how predictive of protected status they are. And this, in theory, would allow a compliance officer or somebody at a lender to say, well, I'm just going to drop these two that are highly predictive of protected status, and all of the other ones will not be all the other variables either not be predictive of protected status or only moderately predictive of protected status. And there's just one problem with that, which is the model bias persists even after the progressive elimination of the most biased variables. And let me explain how that could be true, or how that's possible. So basically, these variables that appear on their own not to be predictive of race, gender, age, other protected status, when combined with other variables, which also on their own are not predictive of race, gender, age, protected status, encode information about protected status. And let me just give you a quick example of how that can be possible. Imagine for a moment that we were trying to build a model that predicted the sex of an individual. And let's say as an input to that model, I gave you a person's height. Well, height is somewhat predictive of sex because men tend to be taller than women, but height is not perfectly predictive of sex because there are really tall women in the world and really short men in the world. And so what if I told you, okay, well, in addition to height, I'm going to give you weight as a variable. Well, weight adds some incremental predictive power to our model because even at the same height, men tend to be heavier than women due to things like bone muscle density and testosterone. Of course, the problem with a model that seeks to predict sex on the basis of height and weight is that it will predict every child to be a woman. So what if I told you, okay, I'm going to give, in addition to height and weight, I'm going to give you birth date to control for the fact that there are children in the world. Now our model for predicting sex is looking pretty good. But if I had told you a moment ago that birth date was predictive of sex, you would have told me that I was crazy. But this is just an example of how variables that are seemingly neutral can interact with one another in ways that humans couldn't possibly discern to encode information about protected status. So just dropping the most biased variables, or most obviously biased variables, isn't going to work. So my view is that it's time for those of us who work in the world of credit underwriting, who care about affordable housing and fair housing, need to kind of reckon with the reality that neutrality is a fallacy. The variables that we are using in underwriting every single day are deeply redolent with information about protected status. And we can't tell that just by looking at them. And in some cases, we can't even tell that by doing a sophisticated univariate analysis, as I showed you. You have to do a more complicated multivariate analysis. And so I think if we admit that neutrality is a fallacy, it kind of begs the question, well, is there another approach that might work? And the evidence suggests that there is. And we call that fairness through awareness. And so what I'd like to talk to you today about is how we leverage fairness-aware machine learning and artificial intelligence techniques at our company to work with lenders in ways that expose their models or their decisioning systems to the differing credit characteristics of various groups in ways that allow you to set the weights on the variables you consider to be more sensitive to those groups. That is to say, we work with lenders to adjust the weights on their variables to maintain their predictive power, but minimize their disparity driving effect. And let me show you how that works. But in order for us to do that, we need to do a quick conceptual lesson on artificial intelligence. So the thing about artificial intelligence, another fancy word for that is algorithms. They're just math, but they are kind of math which must be given a target to achieve an objective. And so if you think about, for example, the Facebook algorithm, social media algorithms, those algorithms are given the target of keeping you engaged. They're going to single-handedly pursue or so relentlessly pursue your engagement, regardless of whether or not the stuff it's showing you to keep you engaged is good for your mental health or good for society. You didn't tell it to care about those things. You only told it to care about engagement, right? And if you stop and think about it, giving an algorithm one objective to relentlessly pursue can have all sorts of unintended consequences, right? Like imagine if Tesla gave the neural networks that power its self-driving cars the mere objective of getting a passenger from point A to point B. Well, the self-driving car might do that while driving the wrong way down a one-way road, blowing through red lights, causing mayhem to pedestrians, right? So what does Tesla have to do? It has to give the algorithm powering its self-driving cars two targets, right? Get the passenger from point A to point B while also respecting the rules of the road. And it turns out we can do this in financial services. We can build models, algorithms, decisioning systems, scorecards that target which applicants are going to default while also minimizing differences in outcomes for protected groups. We call that fairness through awareness. And let me show you a bit about how that works. So we were working with a lender recently who had a model that was quite accurate. You can see here 95.63% accurate. That means for every 100 loans that this lender's model evaluated, every 100 applications, it correctly predicted whether the applicant would default or pay back 95.63% of the time. And it yielded these fairness outcomes that you see down below. So it's actually a model that was quite fair to Hispanic applicants, quite fair to Asian Pacific Islanders, relatively fair to women, quite fair to applicants above the age of 62. But you can also see that it was approving Black applicants at 75% the rate of white applicants, which is below that 4/5 threshold, that 80% threshold that courts and regulators commonly look to as being potential evidence of disparate impact. And so this lender asked us, could we do better by Black applicants while staying within our risk tolerance? And so the first thing we did was, all right, well, let's look at this incumbent model. What variables is it taking into account? And to what extent? And what we saw was there were basically 10 variables that were driving the overwhelming majority of the predictive power of this lender's model. And you can see conventional credit scores were responsible for almost 70% of the predictive power of this lender's model. And the remaining 30% was made up of these variables that are commonly found on a credit report, like the number of times you've been delinquent in the last 12 months, the number of inquiries on your report in the last 12 months, the number of times you've been over limit on your balances, etc. We then calculated, okay, if these are the variables that are driving your decisions, what variables are driving differences in outcomes for one group relative to another? And so what we saw was, again, credit scores were driving most of the disparity for protected applicants. You can see that credit scores were driving about 71% of the disparity for Black applicants, and the rest of the disparity for Black applicants was again being made up of these other variables that were found on the credit report that we were just talking about. And so the question that this lender had was, hey, could we, squeeze more predictive power out of the variables that we're not using very much, but that appear not to have much of a disparity driving effect, and reduce our reliance on the variables that we were primarily relying on to evaluate credit risk, but that seem to have a large disparity driving effect. And so this lender used our software and was able to identify 7 models, each of which would have been as accurate or more accurate. In fact, many of these are about 0.5% more accurate than the incumbent model, all of which would have dramatically increased positive outcomes for Black applicants and for women. And so you can see here the Fair Play models, number 1 through 7, the accuracies are listed there. Each of them is about 0.5% more accurate than the incumbent, which is to say that the addition of that protected status consciousness during model development, the use of that protected status information during model training, added incremental predictive power to the model, right? So it's able to learn something additional by having access to that information that it wasn't able to learn previously about the credit characteristics of these groups, and overall achieve a higher rate of accuracy while also approving more applicants, in particular from Black communities. In fact, model number one here would have increased fairness for Black applicants from 75% to 87%. That's a jump of about 16%. And this lender was using our model as a second look model, a kind of a model that was being used as a final step in their decisioning process to basically re-decision all of the applicants that would have been denied by their incumbent model. And so you could see that they were able to identify an additional 5,200 loans at a higher rate of accuracy than their incumbent that would have dramatically increased fairness for Black applicants. This lender only makes about 60,000 loans a year, so an addition of 5,200 loans is an increase in approval rate of about 10%. So more good loans at a higher rate of accuracy to protected groups. And when we look at the payback rates for those groups, we see that the payback rates are virtually identical. Black applicants are paying back at 99.91% the rate of the white applicants. And when we say, okay, well, what is this second look model? What variables is it taking into account and to what extent? What we see is that the second look model makes more use of more of the variables more evenly. All right, so remember that the primary model was relying on credit score for about 70% of its predictive power. The second look model has reduced the influence on the credit score by about 90%, from 70% to 6.5%. And it's tuned up the influence of these other variables, which are also predictive of risk, but have less of a disparity driving effect for Black applicants. So this lender is able to make more money and do more good simply by reweighting the variables that it was already using in ways that made their decisions more sensitive to historically underserved groups. That's good for profits, it's good for people, and it's good for progress. Let me just conclude by saying that, like, you know, we are at a crucial moment with respect to the adoption of artificial intelligence in financial services. And I think we're also at a crucial moment with respect to issues of financial inequality, because, you know, for all of our efforts over the last 30, 40, 50 years to improve, you know, the fairness of the mortgage market, to improve the fairness of the housing market, to improve affordability, you know, many of the key metrics that we look at haven't budged, despite many great efforts to solve these problems. And so we're at a moment now when algorithms are going to start making those decisions instead of people making those decisions, and make them across a range of domains, right? Not just underwriting and pricing, but marketing and fraud detection and collections and loss mitigation. And I think there's a very real risk that if we don't act today, that the bias of the past will be programmed into the digital decisions of the future. And so, you know, I think it's incumbent upon all of us who work in these spaces, in, you know, the world of credit underwriting and the world of housing finance, as we prepare ourselves and prepare our AI strategies for the digital age, that we also take action to ensure that algorithms are not perpetuating bias in the data that train them. That is doable. There are increasingly good tools for doing it. And I think it's time for us to ask the question whether or not fairness through awareness is an idea whose time has come. Anyway, that's a little bit about what I wanted to share with you today. Buzz, why don't we take some questions if there are any?
Great. And I see we have a question here from Marilyn Rivera. Go ahead.
Yeah, how do you determine which other metrics to look at when you're working with lenders? Yeah, so there's a bunch. Adverse impact ratio is one. Denial odds ratio is one. We look at the average differences in price. So like usually expressed in basis points, but you can also do a computation called a standardized mean difference, which is the average difference in price, but standardized to account for variance. There are several different metrics that you can look at that you typically relate to, is one group experiencing a positive outcome at a higher or lower rate than another group? What's the difference in outcomes between groups? Is one group experience a negative outcome at a higher or lower rate than another group? We've actually done a deck that shows how you can do these computations sort of on the back of an envelope. And we're happy to share that with the audience, or you can go get it at fairplay.ai. Has this information been presented to the MBA or to the big banks? Yeah, I have had the great privilege of being invited to the MBA conference a few years ago. I participate in fora like this. We're heavily engaged with the National Fair Housing Alliance on a mortgage fairness optimization study, the results of which we will be making public in January of 2024. And so we are making every effort to kind of bring this message to the industry and to the other stakeholders who have an interest in hearing it. Looks like there's a question about HMDA reporting. Right, HMDA reporting, race, ethnicity, gender identified has decreased substantially. Yes, I have seen estimates of 50%. Yes, how do you think this is impacting your analysis? Right, so I think for sure we still have pretty healthy sample sizes here. I mean, this analysis over the course of 30 years, I think, is something like, more than 100 million applications for whom protected status information was given. But the questioner is totally right. We sometimes will deal with mortgage originators who are only collecting, whose applicants are only volunteering, 14, 15% of the time their protected status information. For those individuals or for those lenders, we do use the CFPB approved proxy process that allows you to approximate demographic class membership on the basis of first name, last name, street address, and age. Obviously, we can't do that in the public records because we don't have that personally identifiable information. There are also some pretty well-known problems with proxy methodologies, but you're absolutely right. I think that the ecosystem would benefit from a lot more data sharing, especially around protected status information. Is race documented at the data tract or the zip code? I think it's actually at the individual loan level. And then the way BISG works is it works at the census block level using data from the Census Bureau. Are you only considering mortgage activity? Do you have plans to expand into other areas? Actually, we work across the full waterfront of consumer credit. The data I've shown you today is from mortgage, but we work on installment loans, credit cards, auto loans, handset device, and yes, increasingly small business, because I'm sure, as some of you know, Section 1071 of the Dodd-Frank Act is likely to come into force for the for the first time, someplace in about 18 months, although I understand that it's been slowed down a bit by some challenges in the courts. But that's effectively a Home Mortgage Disclosure Act-like reporting regime. And so much as we have publicly available data for mortgages today, it is foreseeable that at some point in the future, we will have similar data for small business lending, which in theory ought to also allow us to construct a picture of fairness in the small business loan market. Have you had an audience with the banking regulators? Yeah, we've been fortunate to brief all of the federal financial regulators on this work, whether it's OCC, Federal Reserve, CFPB, FDIC. I think, they are still coming up the curve and thinking about what the best interventions in this space ought to be. Although we counted all of the press releases from the CFPB last year that mentioned algorithmic bias or discrimination, and we counted something like 16. So, more than one press release a month out of the Bureau last year, sending a signal to the market that these issues are very top of mind. How many financial institutions are using this service? So it's banks in certain geographical locations using the service more than others. Yeah, so we have several big banks who are using the technology today. I would say there are 3 primary use cases in the big banks. One is kind of compliance automation, which is, hey, we send our credit analytics teams, our data scientists down a fair lending rabbit hole 1 quarter a year to do these kinds of testing. And is that automatable? So one area where we're experiencing kind of positive traction with big banks is on the compliance automation front. Another application we're seeing is, obviously there's been a lot of consolidation and mergers in the banking sector. And so one application we're seeing is, hey, we are a bank who bought another bank, and now all of a sudden we have service areas in communities that we're not familiar with, or we haven't historically been doing business in, and we now have to make sure that we're serving those communities equitably, and making sure that our underwriting is sensitive to applicants from those communities, making sure that we're doing a good enough job of actively reaching out to those communities. And so one other application we're seeing in the big banks is, hey, we need to serve, we've either made some commitments, or we need, for one reason or another, need to serve a community that is low and moderate income, majority minority, or just simply new to us. Can you help us with that? The third application we're seeing in big banks is around, we lend our charter to some other third-party originator. So you see that very commonly, either in mortgage, if we originate through, independent MLOs, or an indirect auto where lenders will originate through dealers. And in all of those cases, they want visibility into whether or not those third parties that are using their charters to originate are treating consumers fairly. And then the last application we're seeing is, hey, we want to push our first machine learning model into production, and our compliance teams have never evaluated a machine learning model before. And so we need some help building kind of technical tools for non-technical, non-AI people to quickly understand if the models are fair, if they pose a threat to the safety and soundness of their institutions or to the consumers they serve. What are the flaws? What are the pushbacks? Yeah, so I would say that the biggest, there's maybe 2 primary ones. The first is, as I mentioned, in order to do this kind of analysis, you need protected status information. And ECOA and the FHA say you're not allowed to consider race, gender, or age when you're making a credit decision, which is totally reasonable. But they don't say that you can't use some consciousness of protected status when you're building the model, so that the weights are set in ways that are fair to everybody. But I think over the years, the prohibition on the use of protected status information has been read as, you can't use this data for anything at any time. And I think that's an overreading of what the law is. The law says you can't consider it at decision time, but it doesn't say that you can't use that information to build models that are fair to everybody. And I think that's just going to take some time for the industry and for regulators to wrap their heads around that, because we're so used to the kind of abject prohibition that is kind of dominated our practice since the passage of ECOA and the Fair Housing Act, et cetera. somebody's asked a question about my reference to Second Look. Yeah, so this technology, this fairness optimization technology I've described to you today, you can take it as a lender in one of two ways. You can either adjust your credit, you can either adjust the incumbent or the primary underwriting model, or some lenders don't want to do that. They've, for whatever reason, they don't want to touch that primary underwriting model. So they just want to use the fairness aware model in a kind of as a second look or a double check on the first model. Sometimes they do this as a part of like a special purpose credit program. But you can get the benefit of this technology either by tuning your incumbent strategy or by augmenting your incumbent strategy to redecision your declined applicants or the folks you approved who didn't take their loans, maybe by optimizing pricing for them. I think
so just on that last point, why wouldn't a lender just build this into their primary model?
Yeah, well, it all depends on, you know, how hard or easy it is for you to push a new model into production. For some lenders, that's very easy. For other lenders, especially if they've been cobbled together over the course of many acquisitions and underinvested in their technology infrastructure, pushing a model is quite a bit of work. It can take, you know, in some cases at big banks, up to 2 years. And so, or for whatever, or you may feel comfortable with that your incumbent model in a primary position, but really want to use the second look model as part of some kind of commitment that you've made, like a special purpose credit program or a DEI program, et cetera. So there are, you know, different institutions have made different commitments and giving them the flexibility, both from a policy perspective, but also from a technology perspective, to get the benefit in one of a couple of different ways they seem to appreciate.
So in the first less fair model you showed, very heavy focus on credit scores. There's more than one credit scoring model. Are they all the same with respect to fairness, or some better than others?
Well, you know, there's one score that's kind of dominated the mortgage market for the last 30 plus years. And FHFA has now just authorized the use of another score. That score, I think, was authorized in part because there's evidence that it is more inclusive and does a better job of reaching certain communities. I think that, you know, what we really need is and that's great, but I think what we really need is a competitive marketplace, you know, obviously with guardrails. But, you know, ultimately, I think we may be headed for a world in which 1,000 scores bloom and let there be and those scores may be, you know, adjust, maybe tailored to certain segments or certain products. And so I think that democratization in the world of scores, provided those scores are well validated and debiased, is a good thing.
Credit. We have another question in the chat, Kareem. Asking
the two ways lenders can use the fairness optimization technology. So you can either optimize your incumbent strategy or you can augment your incumbent strategy. So you can say, hey, I just want to adjust the weights on the variables in my primary model. Or you can say, I'm going to leave my primary model in place, but I'm going to put in a second look model, or sometimes we call it a double check model, that basically redecisions all of the declined applicants or the applicants who were approved but didn't take loans, to see if you can either do a better job of underwriting them, or if you can do a better job of pricing them.
How important are alternative payment history metrics here? There's been a lot of talk in particular about such other measures as utility bill payment history or rent payment history. Do those help maintain predictiveness and improve fairness?
Yeah, we see that the closer you can get to a consumer's balance sheet, the fairer the underwriting generally is. And so in my opinion, the state of the art in underwriting data today is cash flow data. If you can actually see the ledger entries in a bank account and make judgments about whether or not people, consistently maintain positive bank balances and so forth, all of that. But as you said, telco data, rental histories, it turns out that like when you underwrite a loan, you're really just like trying to make a judgment about how responsible an individual is. And it turns out that you can find indicia of a person's responsibility in all kinds of places if you care to look. I see. Go ahead. Sorry, Buzz. Yeah.
No, go ahead.
No, I was gonna move to another question. Phyllis has another question, but we can
Well,
talk.
let's just sticking with this for a moment. I've seen some data out of a rent reporting company, and it seems to have a significant effect on credit scores for renters, in part because many of them, I think, have thin files, especially lower income renters. And so I was struck by how that reporting seems to have increased credit scores. And I'm not quite sure what to make of it. I mean, there could be some Heisenberg effect here. There could be, it could be that the credit models for thin files are just so unprecise that they're not really giving a full picture of the person's credit capacity. What are your thoughts?
I think whether or not people pay their rent is highly predictive of whether or not they'll continue to pay housing expenses in the future. And so if you can get that data, it can allow you to be more discerning at the margin.
And do we have enough of that reporting now to really
It's
do much with the data?
there have been improvements, but it seems to me that and there's a lot of people working on that problem for reasons that I don't entirely understand. Reporting is much more difficult than it ought to be, but I'm heartened to see that like we have made some progress in that respect. I think across all three credit bureaus. And I know that there's a number of technology companies and startups who are also sort of working to help those thin and no file, tenants thicken their files.
And I noticed that the CFPB recently put out a statement that said that lenders are responsible for fair lending problems that could arise from third-party credit models.
Yeah.
Can you talk a little bit about that?
Yeah, I mean, I think what the Bureau is saying there is you can't outsource your fairness to some third party and then kind of use a score from a third party and then throw your hands up and say, well, it wasn't me, it was, XYZ score provider. And I think the other thing they're saying is, in a world where you're using more, data that's potentially intrusive, like behavioral data or social media data, you have to be, forthcoming about the fact that you're doing that, and you can't hide behind kind of vague reason codes when you deny people for a loan. So an example I think they give was of gambling. If you're using someone's credit card data for underwriting and you're looking at their transaction history and you ultimately decide to deny them because you see that they go to a lot of online gambling sites, that may be reasonable from a credit risk perspective, but people might not love that you're mining their data that way. And the Bureau's expectation is you're going to tell them, I denied you because you're gambling too much, not like because you've been shopping at some disfavored disfavored retailer or something that's so vague and ambiguous that you don't have an accurate sense for how they're actually assessing your creditworthiness.
Well, that's great. Final word.
I think it's a very exciting time for those of us who are working on fairness issues in the financial services industry, even as the challenges are potentially not, I wouldn't say as great as they've ever been, because we had these policies of explicit exclusion in the past, but now there's a bunch of glass ceilings, it seems to me. So in that sense, I don't know if the situation is better or worse, but it's a very exciting time for those of us who care about these issues, because the technology is making change, I think, more possible in some ways than it's ever been. And so thank you for the opportunity to kind of share the work that we're doing, and thank you for the work that you guys all do. And I appreciate very, very much the efforts that NAL has put around racial equity in the last several years, and I hope others will join you in that effort.
Well, thank you again, Kareem, for a wonderful presentation and very thought-provoking. I also want to thank our audience and our Racial Equity Committee, chaired by Lloyd Brown of Citi. Today's webinar will also be posted on our website in the next week. That's www.naahl.org. And please join us for our annual Policy and Practice Conference. This year will take place November 8th at the National Press Club in Washington, D.C. Information and registration is also available on our website, www.nal.org. Again, thanks to everyone, and we will see you hopefully at our annual conference in November.